Macro surprises, inflation beats, employment shocks, unexpected rate cuts can reprice trillions of dollars across the fixed income universe in minutes. The reason isn't the data itself, it's in the sudden shift in expectations about the future path of policy. Understanding how a single data release cascades through rates, credit swaps, and global markets is essential for reading modern fixed income dynamics. At the heart of the reaction is forward pricing. Markets don't care about today's inflation reading, they care about what it implies for the next 12 to 24 months of central bank decisions. If a CPI print comes in 0.3% above expectations, traders may add multiple additional rate hikes into the forward curve. That repricing affects the entire yield curve, not just the front end. Short-end rates move first, but long-end yields shift based on term premium, growth expectation, and investor sentiment. When a surprise suggests the central bank is behind the curve, long-term yields may rise sharply. When a surprise implies tightening is working, long-term yields may fall, even if the front end moves higher. Swaps and futures rediscover equilibrium quickly. SOFR futures adjust to reflect new expectations for future policy rates. Swap spreads shift based on demand for hedging, dealer balance sheet constraints, and risk sentiment. Credit markets feel the impact next. Higher real yields tighten financial conditions, widening credit spreads, especially for lower-rated companies. Investment-grade spreads often widen modestly, while high-yield spreads can gap out sharply, especially if the surprise affects recession probabilities. Global markets react as well. US Treasuries anchor the world's duration benchmark, so a repricing in the US curve cascades into European, UK, and EM local rates. Currencies also respond. Rate-sensitive currencies strengthen when markets price more hikes, when high beta currencies weaken when risk sentiment deteriorates. One advanced dynamic is the growing importance of second derivative surprises, the rate of change in the data. Markets increasingly respond not to levels but to whether inflation is decelerating faster or slower than expected. This is why a modest downside miss in CPI can trigger a rally if it confirms a trend, even if the headline number remains elevated. A macro surprise doesn't just move yields, it resets the entire fixed income complex. Rates, swaps, credit spreads, and global markets all adjust to a new distribution of policy probabilities. Understanding these chain reactions can help investors interpret market moves and anticipate how shocks will ripple across asset classes.